$200 billion. That's how much capital is on the sidelines awaiting deployment into commercial real estate, according to a recent estimate by Preqin. And that number is predominantly international and institutional capital. It doesn't completely factor in private capital. Historically, private investors constitute about 40 to 45% of the total commercial real estate investment dollar volume. So as a rough estimate, factoring in the private capital, there may be about $300 billion waiting to buy commercial real estate. And if that capital is levered up with a 60% loan to value, that would be about $750 billion of commercial real estate sales volume. To put that in perspective, the inflation-adjusted average commercial real estate dollar volume in today's dollars between 2014 and 2019 was about $640 billion per year. In the first half of 2023, the total dollar volume, according to RCA, was about $186 billion. So, sales activity was way down in the first half of this year, but a significant wave of capital is primed to enter the market at some point. So what's holding it back? Why isn't all this capital coming into the commercial real estate market yet? The first issue is the reduced amount of for sale property on the market. This is partially driven by the expectation gap. Basically, sellers are still in the process of recalibrating their pricing expectations from where the market was in 2021 and early 2022. The current market isn't creating seller motivation. In 2021, it wasn't unheard of for buyers to make big offers in the highly competitive market. Property owners would look at the offers and say, well, if you're willing to pay that, sure, I'll sell it to you. Today, no one's tossing giant offers on the table, so sellers aren't being motivated by price. Seller motivation is basically back to normal. Property owners need a reason to sell their commercial real estate. Reasons could include the end of a fund life, and investors need to tap into the equity of the property, the dissolution of a partnership, or some other life or business reason to sell the property. On the other side of the equation, buyers have been holding back because of uncertainty and a belief that properties are still overpriced. I can't tell you how many investors have told me the same thing over and over again. Prices are too high, cap rates are too low, or they're simply not willing to buy a property with negative leverage. In my opinion, those statements are a fallacy. Here's why. If you knew a property's rent was going to surge by 20% next year, you'd probably buy it, even if the cap rate today is 50 or 75 basis points below the prevailing mortgage rates. Or if you knew that mortgage rates will drop by 100 basis points next year, you'd probably buy as much property as you could get because you could refinance when the rates go down. So the argument that investors won't buy a property with negative leverage really isn't true. Investors won't buy with negative leverage for two reasons. First, investors haven't been willing to bet that interest rates will go down significantly next year. But interest rates could decline. If you look at the most recent Federal Open Market Committee dot plot of expected interest rates, most of the FOMC voting members indicate that the overnight rate at the end of 2024 should be 25 to 100 basis points below the rate at the end of 2023. I can't speak to the historical accuracy of the FOMC's dot plot, but my point is that it is possible rates will go down. The second barrier buyers face is that they aren't focusing enough attention on value creation strategies. Creating value in property is a cornerstone of commercial real estate investing. Investors who can look at a property and find potential upside opportunities are the ones doing deals today, and they're the ones who are getting the jump on the market. Remember, there's $200 to $300 billion of capital out there waiting for market clarity. When that clarity comes, and all that money jumps back into the market, the competitive investment landscape will be dramatically different from what it looks like today. So investors may want to take a minute and consider whether they think interest rates will go up or down next year. They need to look at the properties that are available today and determine if any have value creation potential. They shouldn't lock it into the economic and financial conditions of today. They should focus on where the market will be in a year, 2 years, or 5 years, which is why investors need to keep their eyes on the horizon.